It was a pretty quiet day on Wall Street. We did see the initial jobless claims numbers come out, and we also saw a little bit of negative corporate news out of Apple, kind of put some pressure on the market. But all things considered, it wasn't a massive plunge or anything along those lines. In fact, we remain with bullish postures across the board on all four of our indices. We did have a little bit of fireworks after the bell, and that was with Netflix's earnings report. That stock was down about $50 per share after hours. That was a pretty sizable drop. It's good for about 9%. So that will likely continue to pressure some of those technology-oriented stocks. And remember, that's an area that since Monday afternoon has been underperforming, and it did so yet again today. So we'll take a look at all that, see what it means for our various postures, then we'll get into a trade application example where I wanted to focus on kind of the opposite of a technology company, a consumer staples company that is setting up in an area of interest for dividend investors, and we will look to sell a put to try to attain that stock at a lower price. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 16th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click on subscribe, also check out our description area and sign up for our email distribution list. We're also heavy users of Twitter. Make sure you're following me at Brandon Van Zee. And if you click like and retweet on our Market Outlook related posts, we certainly appreciate that. It encourages us to do these as often as possible. And I do apologize for how late this is getting out tonight. I've been away for a vet appointment for the last several hours. So if you appreciate the effort that goes into these videos, even if it means late night, that's the one ask we have out of you. Just go over to Twitter, click like for us there. And then lastly, we do have a presence on Facebook as well. If you want to join our group there, you can see the web address embedded in the logo in front of you. All right, let's jump into our charts here. As you can see, I've got chart 4B pulled up in front of us, and this will give us a good overview of the four major U.S. equity indices. And so this can kind of give us a sense as to what the trends are looking like and if there's any sort of differences that are taking place amongst the various indices out there. Right now, 3 out of the 4 that we see in front of us have what's known as bullish postures, in fact, strongly bullish postures. The fourth one, in this case in the lower right-hand corner, the Russell 2000, has that lighter green shade to the background color. So it does have a bullish posture. It's just that we would consider it weakly bullish, not strongly bullish. Now, as soon as tomorrow, that might change. The reason I say that is you'll notice in the label here, it says the intermediate line is at 49.72 and rising. In other words, once that gets above 50, if it continues to rise, which is likely, we would change to a strongly bullish posture. So as soon as tomorrow, we might have that. Here's the kicker, though. The NASDAQ has been underperforming since Monday when we had that big reversal in a lot of those momentum stocks. So you'll notice here on the NASDAQ composite that, yes, at this moment in time, we do have a strongly bullish posture, but look at how close that green line is to falling out of the upper reversal zone. So this will be kind of interesting if this flip-flop takes place tomorrow. Right now, we are on the verge of losing our bullish posture on the NASDAQ. If the intermediate line falls from the current 80.61 to below 80, which is likely, right? That's not a big move at all. This would revert back to a bearish posture. Now, how long that lasts is anybody's guess. Remember, the last time we had a bearish posture, it stood there for exactly 1 day. And the time before that, it was only 3 or 4 days. Otherwise, this entire 3-month move for the NASDAQ composite has been bullish. So I don't think I would write off the NASDAQ stocks yet, even if we do get a bearish posture as soon as tomorrow, because we're still above that rising moving average. And we've seen this story play out before. Generally, when the NASDAQ composite has sold off in the past, it's actually been a time to think about reloading the gun for another upside maneuver. So we'll see if that takes place, but that's one thing to set your sights on for tomorrow. The strong possibility that the NASDAQ goes bearish and the Russell 2000 goes strongly bullish. The other two indices are probably firmly entrenched at this moment in time. The S&P 500 is in the upper reversal zone on its intermediate posture, and it's at 85 and rising. So that likely will not fall out of the upper reversal zone tomorrow. And then the Dow Jones Industrial Average, which I commented on Tuesday, how impressed I was with that particular candle right there. It had another big day yesterday, pulled back a little bit today, but you'll notice that the background color of the chart has had a lot of color changes lately. We had a weekly bearish posture there on July 7th. We then went into a strongly bearish posture with a darker pink background color there for about a week. We then advanced to a weekly bullish posture on the 15th or maybe the 14th. And then here the last couple of days, we've had the strongly bullish posture. So we've kind of gone through the full cycle there on the Dow Jones Industrial Average. And we're starting to see some of those industrial names starting to kind of prove their worth here a little bit. I noticed the 3M chart, as one example, is perking up nicely. Also, Caterpillar has been doing a good job of stabilizing and bouncing a bit higher here in recent weeks. So keep your eye on the industrials there. And then, the other thing I'd point out while we're on this particular chart is that we do have what's known as bullish intermediate confirmation signals in a couple of the cases here. So let's talk about those. With the S&P 500, which by the way was down 0.34% today, as I mentioned in the intro, the NASDAQ was actually the worst performer today. It was down 0.73%. It's late enough in the evening now where the Russell 2000's percentage has gone away, but I did check earlier and it was down about 0.6%. So in other words, the NASDAQ was the worst performer today, the underperformer. Anyway, the S&P 500 was the best performer out of these four today. And you can see that the green line, as I mentioned before, remains strongly bullish. It's in the upper reversal zone. And today we also got the red line to sit in the lower reversal zone. So that combination is known as a bullish intermediate confirmation signal. Now, as many of you that have watched this video for long enough know, there are more ideal signals and less ideal signals. This one would be considered a less ideal signal. The reason for that is the near-term line is also in the upper reversal zone still. So, if this is a buy the dip signal, there wasn't much of a dip here, right? 0.34% isn't getting you a whole lot of a dip there. So, in other words, there may still need to be a further exhale, a little bit more than it gave us just today on the S&P 500 before you can get excited for that type of a situation. Down below, now on the NASDAQ composite, here you can see that this is also a bullish intermediate confirmation signal. The green line is still considered bullish at this point, for one more day probably. And we did have that red line in the low reversal zone here today as well. In this case, the blue line is not in the upper reversal zone the way that it was with the S&P 500, but on the other hand, it's not below 50 either. And remember, for a more ideal setup, we want that blue line somewhere between 50 and 20 on the day of the bullish intermediate confirmation signal. So we didn't quite get an ideal setup there on the NASDAQ either. And then you can see that we also had that setup over here on the Dow Jones. It looks a little different because in this case, the green line is not in the upper reversal zone, but remember that is not necessary for the bullish intermediate confirmation signal. Having the red line in the lower reversal zone is a requirement. For the green line, we just need it to be bullish, whether that's bullish because it's in the upper reversal zone or bullish just because it's trending higher as it is right now. Remember, what the bullish intermediate confirmation signal is effectively saying is the security in question is in an uptrend, right? That's why we're looking at the green line. And then in addition to being in an uptrend, we're looking for momentary pullbacks along the way to buy the dips. And those pullbacks along the way where that red line goes into the lower reversal zone can represent those opportunities to maybe add to your bullish positions in those particular securities. So anyway, 3 out of the 4 indices here did finish the day with a bullish intermediate confirmation signal, but because of where the blue lines are positioned in all 3 of those charts, none of them would be considered ideal setups at this moment in time. All right, let's go ahead and take a look at our 3 green arrows. And that will be here on chart. I'm losing my sight here for some reason. There it is. Finally, 4D. And you can see here that we have 3 out of the 4 charts with 3 green arrow signal. And guess what? The one that doesn't have it is the NASDAQ composite. How many times have I said that? Not too often. Usually it has been the NASDAQ that has been the leader, and other charts lose their 3 green arrow signals first, and the NASDAQ has been reluctant to lose its signal. So it's usually the one that loses the signal last. This time it's flip-flopped. This time we have the NASDAQ composite losing its signal first. And so it's a little bit different in that regard. And again, much of that is as a result of what happened on Monday. This candle right here is a dead giveaway as to which day was Monday. On the NASDAQ composite, you had this really nasty reversal where we had a gap up to start the day. We finished the day basically at the lows or very close to it. Along the way, notice what happened. We had a bearish engulfing candle that took place there as well. So a lot of those high-tech stocks and momentum companies have continued to struggle to regain a footing ever since Monday afternoon, and tonight's news with Netflix, as I mentioned before, is not going to help. Just to put that into perspective here, if I were to pull up NFLX, I will show you. Let me right-click and maximize this so you guys can see it a little bit better. But up here there's a bid in the ask. Now we are past the after hours session as well, but where the after hours session ended, Netflix had a bid of $479.08, had an ask of $479.50. In other words, if this holds true, when Netflix opens tomorrow morning, it will be trading below $480 per share. Notice where it closed the normal session here today, which was close to $527 per share. So almost a $50 per share give back. Now on the chart where that puts us, 480 is approximately right here. So, you know, if you're taking things into perspective, I think that you recognize that Netflix has been so red hot that even a $50 per share what some would consider a meltdown is not enough to actually jeopardize the trend. At this point, if it can maintain support above that rising 30-day moving average, that might actually be a time where you consider setting up for a potential bounce to the upside type of trade. Now, that's probably not something that's going to happen tomorrow, so you don't need to, be on high alert tomorrow. Tomorrow's probably going to be a day where you see it plunge, and then early next week we start to see that process of testing those lows. And if it can kind of hold some of those lows and then starts to make what's known as a hold or a close above the high of the low day at some point early next week, that could be an interesting time to maybe sell a bull put spread or something along those lines. We know that Netflix has been amongst those leadership names of this market, not just recently, but let's be honest, for a decade at this point, right? Here's your 10-year chart on Netflix. People who have been sellers on $50 per share down moves in the past have typically lived to regret it. Any major sell-off in Netflix in the past has been a bad idea to sell. Instead, it would have been a great idea to buy. Now, we know that in hindsight, of course, and in the future is far from guaranteed. But what we do know is this is a company that has changed the world. It is a leader in its space. And at this point, with the coronavirus still not behind us, and a lot of people wondering what they're going to do with their time when they're locked up in their houses, I imagine that Netflix will probably be one of the go-to names here, even coming into this fall. So keep your eye on that. Tomorrow, it's going to be one of the big stories of the market. And yes, the headlines are going to look really, really bad when Netflix is down $50 per share. But if you're keeping these longer-term trends in mind, there could be opportunities for those of you that are looking for bullishness out of this starting as soon as next week. Okay. All right. Let's go ahead and take a look now at some 12 grid analysis. Coming on over here to, let's do the 5A chart here first. This will be our asset class 12 grid. Remember, when we're looking at these 12 grids, these miniature charts here, the background colors of the charts in this case will represent what is the current posture. So it doesn't have that fancy flip-flop back and forth of where the postures were changing along the way. It just would look too cluttered when you have 12 charts on the board. So the way we do these ones is whatever color you see with these backgrounds on the charts here, that represents what's the current posture at this exact moment in time. So as you can see, we've got two red charts on the board, and that's over here with VNQ, which is the Vanguard version of a real estate fund. So real estate not doing so hot there. Interestingly enough, The REITs, which make up the biggest chunk of VNQ, haven't necessarily been doing all that great, but I did notice that home builders themselves, so the folks that are building the homes, Lennar and D.R. Horton and Pulte and a few of those types of companies, they're actually doing quite well. So it's interesting to see that difference there. The people who are in charge of building the houses and selling the houses are doing reasonably well. People who are in charge of collecting rent are not doing well. And that, of course, is a continued story since March, when we've heard even companies as big as Gap Stores and Cheesecake Factory refusing to pay rent. And so a lot of those REITs are stuck between a rock and a hard place right now as a result of the difficulties surrounding COVID-19. So REITs right now struggling. They're falling below a falling moving average with a strongly bearish posture. And then, of course, we've been talking about how interest rates have been slipping here for quite some time as well. So this is not a new story, but just be aware interest rates fell yet again today, and the 10-year ended at 0.61 here today. So all the rest of the charts are green, and that's a positive sign, at least if you want to be bullish on them. You can see that the dollar has kind of been a story we've been following closely here. Dollar actually rose today, and you'll notice that it was enough of a boost where that background color flipped. Remember when we were looking at this on Tuesday, that was a pink background color. It has now flipped to that light green shading there, telling us that we now have a weekly bullish posture. The intermediate line is at 23 and rising. Remember, it doesn't get to be a strongly bullish posture until it's above 50. So it's got a long ways to go before that. But it is a start. Now, again, I'm going to be a little bit cautious about how I would look at this chart because price is still below a falling moving average here. And the last time it even approached that moving average, which was right around here at the end of June, it kissed the moving average and used it as a launch pad to rocket back lower. So right now, I'm going to make the assumption that that pattern is going to hold true. We'll see if it does or not, and we'll keep you posted here because the dollar, of course, does have some influence on a lot of other areas of the market itself. One of those areas is commodities, and you can see just to the right of the dollar, you have the gold chart. Gold sold off today. It was a pretty aggressive sell-off, almost 1% there on GLD. As a result of the dollar strengthening, commodities tend to weaken, and we did see that here today. You'll also notice that as of yesterday, gold closed with an overbought cluster signal. So we might be getting a little bit overheated in that particular move, and that is a move that, of course, we've been following quite closely in these videos and benefiting from more times than not. Haven't won every single one of our gold trades, but we've been winning more of them than we've been losing, and so we've been happy about this continued push higher by gold and the gold miners. We'll see where this move brings us, but keep in mind the possibility that if we do get, let's say, the next 3 out of 4 days to the upside for the US dollar and it starts banging its head up on the underside of that falling moving average, we might very well also see in conjunction with that gold falling down to its rising moving average. And if it does look like it's going to test that rising moving average and then bounces off of it, I think that's another excuse or opportunity to go long gold or gold mining companies. So be on the lookout for that. It is possible we get a little bout of weakness here in the extreme short term on gold. In terms of some of these other charts here, I've been talking about foreign bonds continuing to look impressive here. They had another update today. We did see that foreign stocks sold off. So China in particular, I understand, struggled here, which is unfortunate. We actually just selected a Chinese stock for my top-down trend trading class on Monday. Sometimes you're just on the wrong side of the trade, and that one, who knows, might be the situation there. But regardless, we did see a very nice move into a lot of those emerging market stocks here in recent weeks. We've been given back a few of those gains here in the last 1 week, and we remain in an uptrend despite that 1 week pullback. So the intermediate trend is still intact. I would still probably prefer EEM right now just from a purely chart perspective more than the developed foreign stocks and U.S. large cap companies. I think the chart on EEM looks better than the chart on EFA and better than the chart on SPY. Preferred stocks had a nice little pop here today. I don't know necessarily what was behind that. course, a lot of preferred stocks come from financial institutes, and so this week was the initial kickoff week for earnings season, and usually at the front of the parade are a number of the big banks like J.P. Morgan and Wells Fargo and Bank of America and Citigroup and Goldman Sachs, Morgan Stanley, all those guys. So anyway, remember that preferred stocks oftentimes, not always, but oftentimes come from big financial corporations. And so maybe some positive vibrations coming from those earnings report helping to support the preferred stocks of those securities a little bit more as well. So PFF, pretty nice little bounce off of that moving average here today. All right, let's go ahead and now take a look at our next 12 grid. This will be the U.S. sectors 12 grid here. And as you can see, we've got two pink charts on this board as well. One of them we kind of discussed already. This is real estate in the lower right-hand corner. Now remember, this is XLRE, which is slightly different than VNQ that I mentioned previously. But they are both chocked full of real estate investment trusts. So what drives both of them is probably about the same. And I don't need to repeat myself, but obviously collecting rent has not been as easy these days as it had been prior to coronavirus. Energy is a continued house of pain. Of course, you did have a very nice launch higher there in June, but that fizzled pretty quickly. And you went from looking like this, it was going to break out, waiting years and years and years for a breakout. We finally got a really nice move there, and then boom, that thing just completely collapsed to the point where you actually got oversold cluster signals. And if you look at all of these charts, those are the only green dots you see on the charts there. And I'm talking about all 12 of the charts in front of us. We got 3 green dots there on XLE, suggesting that that move had been pretty aggressive to the downside and we might get a slight reversal. And that is exactly what we received here over the last week or so. Now remember, that doesn't mean that the trend itself has to reverse. It just means that the selling pressure has been so extreme that there's got to be some sort of a give back, and that's what we've experienced here more recently. But again, right now, with that falling 30-day moving average, I'd be a little bit more cautious and hesitant around those energy companies right now, at least for the short-term perspective. In terms of the other charts on the board, they're all green. Some of them probably look a little bit better than others. You will see that technology did fall again today. So I suspect that when I put together the sector selector tomorrow night, unless technology has a big day tomorrow, we might see technology slip again. Remember, they already slipped one rank last weekend, and I suspect they're going to slip yet again here tomorrow night unless they have some sort of a big day tomorrow. Now, they're still above a rising moving average, so we don't want to make too much of it. It's just that they're kind of losing their grip on their leadership role where they were previously. And, that all starts with stocks like Apple and Microsoft. And, if we were to look at a stock like Apple here today, it was down 1.23%, and Microsoft was down almost 2%. So both of them still in uptrends. Again, not trying to be alarmist here, just basically pointing out that they are not firing on all cylinders the way that they had been up until this week. So let's keep our eye on technology. If you've got some trades that are a little bit long in the tooth from that particular sector, you might start thinking about perhaps selling some covered calls against those positions, or maybe lightening up on your position, selling half, something along those lines if you start to see further deterioration in that particular area. You will notice that materials continue to impress. I brought this one up on Tuesday as well, saying that this is one of the better performers on a month-over-month basis. Well, in the 2 days that have happened since then, we've actually shown even additional progress, because with today's move, our intraday high was higher than where it was trading at the beginning of June. Remember, on Tuesday, I was impressed with this candle, but said, hey, we're still a little bit below that, so there might be some resistance there. Well, in the last couple of days, we're now up and over there, and you can see materials was actually up today. Think about that for a second. The S&P 500 was down 0.33% today, but the materials were up 0.33%. So there's some real strength of brewing there within the materials space. But again, remember, materials and energy are also very dollar sensitive, US dollar sensitive. So if we do get a little bit of a pop higher out of the US dollar, that could have the potential of negatively impacting materials and energy. So materials had been benefiting from a falling dollar for quite some time, but now we're getting a little bit of a snap higher in that dollar. So let's keep our eye on that. We might have to give a little bit back there on some of those materials trades as well. The other area that I think is impressive to me at this moment in time is the consumer staples. Take a look at this chart down below here. I don't think a lot of people have been talking about this, quite frankly, but maybe we should. Take a look at the intermediate line right now on consumer staples. This is XLP. The intermediate line reading is 85.2 and rising. Now look at the intermediate line readings on all the rest of the charts. I would venture to guess that very few people would have guessed ahead of time that right now the consumer staples actually have the strongest intermediate line out of all 11 sectors. You know, a lot of people have not been talking about it. People had more excitement talking about communications and technology and other areas, but you know, don't fall asleep on those staples. And you can see here that yesterday we broke to new multi-month highs on the staples. Today we were up 0.21%, but we were not able to get to a new intraday high. The closing price was actually a new closing high on a multi-month basis, but we did not get to, on an intraday basis, higher than where we were trading yesterday. Nonetheless, this is a strong move for those consumer staples. We've been carving out those higher highs and higher lows there. So that leads us into tonight's discussion on our trade application example. And for that, I want to talk about a company that's already reported their earnings, so we don't have to worry about some sort of a landmine like, you know, some people that are long Netflix tonight are probably going to feel in the morning. Those can hurt a little bit. So I'm going to come over here for our chart 2A. This is our dividend stair-step chart that can kind of help guide our decisions as to when and where we want to purchase security for the long term. And the stock I want to bring up is Pepsi. So Pepsi, as I mentioned, already reported their earnings. So that's already out of the way. We don't have to worry about that potential landmine there. They reported their earnings here just 3 days ago. They actually missed the number. So you can see here that Pepsi was trending higher like we saw with so many other consumer staples companies. But since their earnings report, they've actually sold off. Now they haven't broken any major trends yet. It's just that the market has been a little bit more disappointed. Now, for those of you that are not as familiar with this company, I know a lot of you are because you've been in my classes for the last 5 years as I've been, sharing, the business model with those of you that are interested in dividend aristocrats like this. But remember, Pepsi is driven just as much by its snack line as it is by its, namesake Pepsi Cola. It is the owner of Frito-Lay. So for all of the folks that are stuck at home, watching their Netflix, what are they doing? They're probably snacking on Doritos and Cheetos and all of these others, Lay's and these other companies that Pepsi owns, and that has somewhat benefited them a little bit more so than what you would see out of, let's say, Coca-Cola. Remember, Coca-Cola doesn't really have a snacks division. They are mostly beverages, and so the snacks has really seen an uptick, an increase because you can't really pound a bunch more Coca-Cola or Pepsi Cola during the day if you're at work or at home. But I think the general tendency is if you are going into the office, you're probably not just grabbing a bag of Cheetos and opening them up and just stuffing your face. Whereas if you're sitting at home and you're doing your job from your house, or you're not working right now and you're at your house, you're a little bit more prone to snacking a bit more than you would be if you were in the office. So I think that part of their business has actually benefited to a slight degree from what's happening here with COVID-19. Now, the way that you would look at this particular chart, I call this the dividend stair-step chart because, as you can see, it looks like it has stair steps on it. And this effect will only occur when you have stocks that have long histories of raising their dividends. This is a customized number that needs to be manually input into these stair steps that I work on each year. For those of you that are premium members, remember this is part of your premium service you get from Market Scholars. So when you pull up 2A after importing it into your own Thinkorswim platform, you can go through about 700 or 800 stocks that are inputted into this dividend stair-step system that I use. But the general idea behind it, for those of you that are not as familiar with looking at it, is you're trying to get a sense of when is a good time to lock down a high-quality stock for the long term. And there's an average high-yield theory out there that suggests that if you are able to regularly buy a company after it sells off when its yield is higher than it historically is, that would be an interesting time to pick up some additional shares. And all you have to do is look at this chart to see how well it's worked for a company like Pepsi. And remember, like any technical analysis, there are some stocks this doesn't work all that well on. Some stocks, abide by it a little bit better. Pepsi is one of those where when it goes into the blue zone, it typically is a better time to be thinking about buying that stock and not selling it. And so, had you bought it in the blue zone back over here in 2011 when it was trading around 58 bucks, you'd be thrilled with that purchase at this point. If you bought it over here on the mini flash crash day, we actually talked about this in my online coaching session today, that was in August of 2015, you'd have been thrilled to pick up Pepsi on that particular day. If you'd have bought it over here in late 2018, you would have been happy today owning Pepsi. So at this moment in time, you can see we're not trading in the blue zone. We're trading in this white zone here, saying that we're neither overvalued in the orange zone nor undervalued in the blue zone. We're kind of neutral at this point for a long-term investor's perspective. So one of the ways that we can try to rectify that situation is, rather than thinking about buying the stock by itself right now for your long-term dividend portfolio, instead sell a put at a strike price that would allow you to pick up the shares only when it enters into the blue zone. Now, there are no guarantees that's going to happen, but the benefit you have when you sell a put is you take in premium to start that trade. So if the stock were to reverse course and go a bunch higher and never enter into that blue zone, you get to keep that premium along the way. So note right here that the price I would be looking at adding Pepsi at this exact moment in time is when it's trading at 125.85, so just below $126 per share. It's at that price that Pepsi would be yielding 3.25% on its dividend yield. Right now it's yielding 3.05%. So in order for it to see a higher dividend yield, of course, its stock needs to fall. And so it would need to fall from a current $133 down to $125. So let's go hunting for an opportunity within the options market to see if we can take advantage of that concept. Coming on over here to the trade tab on the paper money account, you can see that as we go out here to the August monthly contracts with 36 days left until expiration, we can come on over here to the $125 put, and you can see that our return on risk is just over 1%. You can see that the last price that particular contract traded at today was $1.34, which is exactly in the middle of the bid and the ask here currently. So there's a decent chance we could get filled at $1.34 as soon as tomorrow morning as well, assuming that it doesn't have some sort of a big gap up in the morning. And right now with Netflix pressuring the market, futures might very well be down as we go into the open tomorrow, and that could help facilitate getting this trade done a little bit easier. But again, what that does, for those of you that are unfamiliar with the idea of selling a put, is it puts you on the hook for buying that stock at the strike price that you selected to sell, in this case $125. So the stock is trading close to $134 right now. You would need to see that fall almost $9 per share before you would be forced to buy 100 shares of that at $125, and that would have to happen on expiration day in 36 days from right now. Now, if that doesn't happen, if it does not fall below 125 36 days from right now, then the money that you take in up front is yours to keep. In this case, if we got filled at $1.34, that's $134 that comes into your brokerage account that you can do whatever you want with. That's your money. And if the stock doesn't go down below there, you might be interested in maybe selling another put the following month, right, in the month of September, and so on and so forth. But this is a way to recognize, hey, this is a high quality stock that you might want to own in your portfolio. You just don't want to buy it right here. However, you'd love to buy it at this blue line here. And in this particular way of going about it, you get paid effectively to say, yes, I will be a buyer of that security if it does fall down to that level. And in the meantime, you pay me $134. So let's go ahead and place that trade. I'm going to come back on over here, click on the bid price, which would be a sell of that put, so -1 of the August 125 put on Pepsi. And in this case, I'm going to try to get filled at the same price that it traded at the end of the day today, which was $1.34. I'm actually going to put this in as a good till cancel order as well. So that way, if it doesn't get filled tomorrow, I'll be happy to do it early next week if it comes down to it. Confirm and send. Here's where you're seeing $134 coming into your pocket whenever this trade gets filled, but then you are on the hook for buying 100 shares of it at $125 if it does fall more than $9 per share in the next 36 days. So let's go ahead and send that off. All right. Thank you so much for joining me here tonight. Again, I apologize if the video is coming out a little bit later than I would prefer. Had a busy day once again. If you appreciate hearing from us on a daily basis, whether it's early or late or otherwise, we would encourage you to click like. Remember, we don't get paid to do these videos, so we try to use these videos as promotional videos more than anything. But you can imagine that if people aren't interested in hearing from us, we wouldn't put in the couple of hours of effort to produce the videos either. So we need to hear from you is the point. And so the way that you can let us know that you appreciate the videos is simply by clicking like for us on our post over at Twitter, which will be pinned to the top of my timeline. Tomorrow, David will be back with you, and make sure you look for my sector selector post tomorrow night as well to see if we have any sector rotation to be aware of. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.